China and Canada both unveiling their own countermeasures against U.S. tariffs. China will enact a 34% levy on all U.S. imports, and Canada planning to tariff all U.S.-made vehicles at 25%. Canadian Prime Minister Mark Carney calling President Trump's protectionist policies a tragedy for global trade.
Our old relationship of steadily deepening integration with the United States is over. Well, this is a tragedy. It is also the new reality. We must respond with both purpose and force.
Joining us now to discuss what's next in tariff negotiations, Kevin O'Leary, O'Leary Ventures Chairman. Kevin, great to have you back with us. Thank you for making the time. I want to start on these tariffs. The market is on track right now for its worst weekly performance since March of 2020. How do you continue to be an advocate for these tariffs, given the sell-off we're seeing, given that I have had every source on our show this morning say that these tariffs will be causing a recession in the United States?
They don't know that yet. They don't know how long the tariff's going to be on. We've never done this before. We've never taken on the entire globe. Usually it's done in trade agreements with specific countries, such as NAFTA, which was Canada and Mexico, or a European Union situation. This is unique, over 60 countries. Now, there's two aspects to these tariffs. Number one is reciprocality against tariffs from one country to another based on products and services that are specific. So if you're charging a 20% tariff in India, it's going to be reciprocated in the United States. And those go away pretty quickly. That actually leads to fair trade. The more complex aspect of these negotiations are around the idea of trade imbalances. And so when you put on tariffs to try and fix trade imbalance, it's difficult because the largest economy on earth is the United States. So really you're starting a behemoth negotiation, and it's happening in every country. You highlighted Canada, but you might as well talk about Britain or even Switzerland, where I am right now, where they have over 30% tariffs imposed 48 hours ago. And so you can assume that behind the scenes are two spheres of negotiations. One is, let's try and reduce the imbalance of trade by buying more stuff from the United States. That's one signal. And the other, which is very easy to fix, is simply remove all tariffs. If you're going to have reciprocal tariffs at 20%, 30%, 40%, just get rid of them, bring them down to zero.
But Kevin, as of this morning, with a 34% retaliatory tariff from China to the United States, we are not getting closer to free trade. We are just getting further into a trade war.
No, China's a whole different story. This isn't about trade war with China. This is about leveling the playing field on a wide range of issues, including IP law, access to business, access to courts, being compliant with U.S. regulations on securities. There is a laundry list of grievances with China that have been around since they joined the WTO. And none of the administrations previously have ever dealt with China.
So why are tariffs the right way?
Dealt with for the first time. So this has nothing to do with just tariffs. I mean, right now I can't litigate.
But that's the tool that the administration is using. Why are tariffs the correct tool if, to your point, these have nothing to do with tariffs?
What tool do you suggest they do when nothing else has worked?
I'm not the president. It's not my job.
Well, exactly. So let him do his work. China's different than all the other countries.
But it's not
China
working,
has to be dealt
right?
with. Look, I'm having lots of problems with China, as are millions of other companies in the United States that try to do business there. They do not play by the rules. They're going to have to start doing it pretty soon. That's a different conversation. You want to talk about the markets correcting? Yes, they are. By the way, markets correct every 18 months, up to 20%. You're watching it happen right now. It's not pleasant. You can't blame just the tariffs for this. These have been very expensive markets now for almost 18 months. Now they're having a correction. I think what matters is this a recession signal, yes or no? And how long will these tariffs be on? I would say 50% of these tariffs across these 60 countries will be negotiated pretty quickly, including the Canadian situation you made details on. Canada's different because they're in the middle of an election. Carney's not an elected official. He has no mandate from the Canadian people. He's just an interim prime minister when they threw out Justin Trudeau a few weeks ago. He's got to get elected first, so he's going to say anything he possibly can to try and distract Canadian voters from the fact that his party bankrupt the country. 25% of Canadians live in poverty. They have had no GDP growth for 10 years. There's no investment capital in Canada anymore, and the dollar's lost 41% of its value. Canadians can't go to the United States because they can't afford it under Carney's leadership in his party. So those are different issues too. There's a lot of things going on at the same time.
A lot of things that economists tell me are not fixable via tariffs, but I am curious from your perspective then, why do you think that we are moving towards a negotiation where these tariffs are not going to be as bad as they seem right now, at least for financial markets? What is it that gives you confidence that there is going to be a negotiation reached?
Because there's a good reason to do it. I mean, you got to distinguish the noise versus the signal. I've said this countless times about Trump. Let's take the Canadian situation, which we've been talking about. If you combine those economies, I'm not saying buying the country, but if you combine the economies, which seems impossible to do given the rhetoric and what's going on right now, but the truth is, the signal is it would be much stronger against China if there were no tariffs between Canada and the United States and they had a common currency and they protected the northern border, not the 49th parallel. Now, the Canadians know that's worth it because 75% of their output has been sold to the United States for over 120 years. 17 states call Canada the #1 trading partner. 28 states, in addition to those 17, #2 trading partners Canada. So it'd be economic suicide not to work this out. The obvious answer is to remove all tariffs, and that will happen, my guess is, right after the election when the Canadians make their choice about who they want to lead them. That person will fly to Washington immediately and start negotiations, which I would call NAFTA 3. But right now, that's not happening because Carney's trying to use this whole Trump issue as fulcrum to try and distract Canadians away from the facts that he wiped out the country. Maybe he'll get elected, maybe he won't. Nobody knows right now. But nothing's going to happen on the Canadian situation until the election's over in just over 5 weeks.
So let's talk about the Canadian citizen reaction, because we've already seen evidence of Canadian citizens boycotting American products. We've heard from CEOs that they are concerned about that, even airline CEOs and the governor of New York being concerned about Canadians not wanting to travel to the United States. Are you getting that pushback from your fellow citizens in Canada?
No. You can understand if you've got the froth and rhetoric around an election cycle, why you would get some of that. And some Canadians are unhappy, there's no question about it, but Canadians are not stupid. They understand the economic advantage of working and selling to the United States and having no tariff whatsoever. The behemoth economy is a golden jewel of an idea, and everybody gets that joke. Americans do not hate Canadians. Canadians do not hate Americans. Politicians have lots of rhetoric when they're trying to get elected. That's what they're doing here. All of this will pass too. What drives everybody long term are economic interests. And that's what really you should focus on here. This will pass. Things will calm down. More rational minds will sit at a table across from each other in about 6 weeks in Washington and in Ottawa.
More rational than the president?
At the end of the day, the president's not an idiot either. Neither is Ludnick or Burgum or any of those people negotiating these deals right now. You have to look at the economic opportunity. They're not idiots. They're negotiating. This is a giant, nasty negotiation with a little bit of politics and a little dash-will-do of politics because of the crazy timing of the Canadian election. Trump has a 4-year mandate. At least 2 of them are in a majority situation. If he's going to do all this volatile stuff, which he's doing right now, he's got to do it now because he may not have a majority mandate after the midterms. So that's why you're getting such an accelerated pace of policy. These tariffs, as I said earlier, 50% of them can be easily melted away to a reciprocal of 0 tariffs. And then this trade deficit is a trickier situation country by country. The only reason there's a deficit in Canada is the fact that so much oil is imported from Alberta into the U.S. economy. If you took away oil, Canadians buy more goods and services from the United States than vice versa. There is no trade deficit ex oil. So that is obvious too. The numbers are the numbers. It will get resolved. And I think calmer minds will prevail after the election is over in Canada.
Kevin, I want to end on TikTok. Both President Trump and Vice President J.D. Vance saying a deal to sell the app will be reached before this weekend's deadline. And then on Air Force One, President Trump said tariffs on China could be part of that negotiation. Take a listen.
We have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate.
So if tariffs and TikTok are now getting tied by the president, where does that put your bid for TikTok in terms of your negotiation power? Where does your bid stand right now?
Well, there's many bids. There's no question that there's a deal for TikTok on the table, and that will get one thing with certainty. Tomorrow before midnight, an extension, my guess is 90 days. It'll be punted down the road because the details of the TikTok deal are very difficult. Let me explain two big issues. China has not said what they want to do yet. The current idea is to get a copy of the code and make an American version of it. And we're not sure that passes muster with the law. If you can download, anybody in America can go get the Supreme Court order. The top of page 5 makes it very clear you can't use the Chinese algorithm. So what we're going to have to do, if that's the plan, is get an indemnification from Congress or change the law to make it legal to use that. And that would require 51 votes in changing it, and maybe they could slip it into the Reconciliation Act. All of these are unknowns. But right now, the penalty would be about $820 billion. That's $5,000 per user account per 24 hours times 172 million. And no capital stack of any of the syndicates formed can take that risk. So we need clarity on what's allowed and what isn't based on the law that was passed by Congress and the Supreme Court order. Remember, it was 9-0. There was no ambiguity in it. And so somebody has to figure that out and either give financiers, both the debt and equity structures, some kind of indemnification against that penalty coming back. Because remember, that law will last long past Trump's administration. So if you have an ambitious attorney general that perhaps is a Democrat, you'll get sued for $800 billion.
Yeah.
Nobody can afford that. So we got to solve that problem. We got to figure that out. So these are the things that we're going to have to get worked out in the next 90 days to get this deal done.
No relief for big tech stocks today. They are plunging again after seeing their worst day since the pandemic yesterday, dragged down by President Trump's new tariff policies that sparked a widespread sell-off. Apple leading the declines among the Magnificent Seven stocks yesterday, seeing its biggest one-day drop since 2020. Joining us now in our studio, Dan Ives, Wedbush Securities Global Head of Technology Research. Dan, you tend to be a very positive guy on most of your coverage. And your notes in the past few days have been as pessimistic as I have ever seen them about what this is going to mean for technology companies. I mean, what kind of hit is this going to cause? And are you assuming that the tariffs are going to stay in place?
Yeah, and I'd say, look, in 25 years going through, when you think about dot-com bubble, burst, financial crisis, COVID lows. So, I've seen every type of crisis there is. I think it's the most absurd thing that I've seen in terms of those 25 years. And I think it's an economic Armageddon that's coming our way. And I think it could ultimately set U.S. tech back many years. And that's the thing that a lot of people don't understand. Talking to executives around the world the last 48, 72 hours is that I don't think a lot of tech companies are going to give guidance in terms of 1Q. And I think baked in here is already called 5-10% cuts off the bat in terms of growth. If this stays, it ultimately, look, this becomes a black swan event. You're playing with third rail issue here.
Is that priced into these stocks if we see this kind of magnitude of decline hold today?
No, because obviously with China, and they're not going to lay down. So
right, they've said this morning 34% tariffs right back on U.S.
Of course.
goods.
And then I think it also comes down to the tariff chart, which continues to be a sci-fi, sort of comedy show. Those are not the right tariffs. So it starts with what's the number you actually even start with in terms of negotiations? And the longer this stays on, you can't stop a snowball once it starts. So the point is do you burn the house down, but you still have a bagel in the toaster oven at the end of the day? And I think that's the frustrating thing right now for tech investors. Stocks are not Republican or Democrat. They speak volumes to what they're showing you, and I think that's the problem.
To the point of China retaliating with additional tariffs this morning, how does all of this play into the fact that the U.S. has been the dominant place for tech investors for so long? Does China start to outcompete the U.S. on tech?
It's a great, but just even go back to, for years, the reason China was such a bad market, you didn't know what the party was going to do over a weekend. So you couldn't invest in China.
Right.
To some extent, that's kind of what's happened here. So that's why I've seen so much global money going to Europe, going to China, going away, because you don't know what's going to happen. I think it just comes down to what's the reality? Is Back to the Future on TV? Is Hasselhoff on? We're not going back to 85 textiles in the U.S., despite whatever they say in the Beltway. The reality is that the US tech infrastructure is built with supply chain in Asia. If you like $3,500 iPhones, we should build them in New Jersey. If you like $1,000 iPhones, you build them in China. And I think that fundamentally, and also it takes 4 to 5 years to build a factory.
And can we talk about that? Because I'm getting a lot of questions about your note on that, and people are interested in how you got to that $3,500. So for context, Dan had a note saying that the iPhone could be as expensive as $3,500 because of tariffs. Right now, it's around $1,000.
If they were built in the U.S.
Correct.
Now, off the bat, just on the tariffs, it's over $2,000. In terms of, you just look at the actual China
but
tariffs.
If I go to buy an iPhone after April 9th, how much is that? That iPhone's going to be $2,000. You think that Apple is going to raise prices immediately on iPhones?
I believe after Memorial Day, it's over $2,000. Because they can't, Julie, they can't absorb, we're not talking like 3 to 5% through the supply chain. They can't absorb a 50% hit. And then it depends on whatever, we gotta see what exemptions they get or whatever. That's why this is, look, it's a black swan event. And going back to 3,500, look, the reality is, so many people that watch us from afar, they've never been to a fab in Taiwan, China. They don't understand. We don't even have you have labor where people, whether Starbucks, Chipotle, $22, $24 an hour. The reality is it would take them $20 to $30 billion in 3 years to move just 10% of the supply chain to the US. So you could talk in front of the microphones and the Beltway, and it could sound awesome. You could paint this fairy tale Pinocchio picture. Yeah. That's the reality, and that's what stocks don't lie, and they know it.
So when do you, because you're still overweight all of these names, when do you change your rating? Is it Memorial Day when you say the iPhone's going to be $2,000? What is it that causes that real fundamental hit?
Well, by then it's too late. Because I already think, like, just the fact that this happened, I'm already seeing the uncertainty across tech. You know, it's not just consumers, enterprises, hey, let's slow down CapEx. What does this mean? That's already factored in 5-10% cuts. If this actually goes into effect and lasts, let's say, a month, it's in my opinion, it's guaranteed recession. And you now start to be like, okay, now it's a game of chicken. Like, ultimately, when do the tariffs, do those get negotiated? What do they look like? But as it's happening, guess who gets hurt? It's the U.S. consumer. And that's why I just continue to stress is that all the companies and all the investors I talk to around the world, the reason I'm so negative is that this is a self-inflicted, worst policy decision in 100 years, and I don't even think it's a debate relative to everything I've seen.
So to Maddie's point, April 10th, do we see a wave of downgrades from Dan Ives if this is still in place?
Look, I think we got to evaluate what numbers look like, because I can tell you right now, like NVIDIA, you're already baking in numbers come down 10-15% at current price. So if you start to see some negotiations and you're able to basically be like, okay, toss out March quarter, okay? Because that's basically in the past, 2Q is going to be a disaster. Street will be able to look through 3Q, 4Q, okay, what's normalized 26. But to sit here and say, no, Tara, this is no big deal, I think they're not going to leave. You'd have to be from an alien nation to actually think that.
So for NVIDIA specifically, obviously the big deal, I mean, it's already sort of navigated around China to some extent. It's really the Taiwan tariffs, I would imagine, that are the biggest deal for the likes of NVIDIA. So what if the tariff stays in place on Taiwan, like what are we talking about?
And you guys see the semi piece in terms of like what they're actually, tariffed at. And
you mean if there's the sectoral
the sectoral tariffs. Right. And then the reality is that it's about growth. See, that is the biggest thing here. It's not even just the cost and the impact there, it's growth. It's company X being like, hey, I was going to spend on these projects, let me slow down till we see what's happening in our business. And that's the problem, self-fulfilling prophecy as this comes out. And I just think it continues to be the most befuddling, absurd thing that I've seen, self-inflicted economic Armageddon, and I don't think there's a debate.
These tech CEOs who were proudly there on Inauguration Day, now the Mag 7 losing $1 trillion in one day, in your conversations with them, do you think that they regret that support?
Look, I think in Silicon Valley, they are dystopian. I mean, it was like they're waking up being like, it feels like an altered universe in terms of the way that Trump has navigated this handling. Reciprocal tariffs, you knew was on the table, 10, 15%, play games, poker, fine. But to actually try to build this chart from like the Goodwill Hunting chalkboard at MIT lab and say it's some fancy chart, it's basically, it's essentially a trade deficit converted into some weird tariff chart. It's not real tariffs. So that's part of the problem, is that that's like me saying like I play in the NBA. And my name's Jim. So how do you even know? Where do you even start with the conversation?
So as an investor right now, when you're looking at all of these large cap tech stocks that are falling, what are you telling people to do? Just do nothing? Sit on if you have them, just hold on to them and wait.
What we're doing is we're basically going through worst case scenarios. Where can NVIDIA earnings be? Worst case. What is Apple? Microsoft. So you have to do scenario analysis and then basically say, okay, based on this, is it base case, best case, worst case, do scenarios. And look, we're taking out the COVID 2020 playbook. So you're basically looking through like, forget 2Q, probably forget 3Q. What do normalized earnings look like when you go out to 26, assuming that this normalizes? But then the problem is that you can't put the genie back in the bottle. Does it create something that's much more sinister in terms of a black swan? I think that's the worry. Yeah. And then also it just comes down to like the confidence in the Beltway. It's something that unlike anything I've seen, I've navigated everything from .com bubble to today. Right. So that's why I don't just sit here. So many of those other moments were times that just you buy them, you don't work. This is one, you cannot say that given you don't know the rules of the game.
So really quickly here, how long for these stocks to recover and how long until we start hearing about layoffs at these tech companies?
I think you don't have layoffs for another few months because until you have a good sense of what the actual policy is in negotiations. So I don't think any companies go down that route. But when it comes to like how low can they go, it comes down to like, till you bake in a full-on deep recession into these numbers, then the stocks could continue to fall.
One more question, going back to the iPhone. If you're thinking you might want a new iPhone, but you've been going back and forth, you better go get it right now. I mean, are we going to see this sort of bump in Apple sales ahead of the tariff imposition?
Yeah, but that bump is it's meaningless relative to the dark storm that's coming. And then it comes down to like the average car is going to go up $5,000 to $10,000. So when the reality of that, UAW workers, they could be happy at that moment, but then all of a sudden when you have to lay off 15, 20%, your GM4, it's not such a happy day there. Yeah. So I think that's the reality, is that many are underestimating the unintended consequences of what's happening in the worst policy mistake in the last 100 years.
You know what you just reminded me of? How do we get through a conversation with you without talking about Tesla?
Yeah.
Is this like unprecedented?
Look, and the reality is when you look at Tesla, like Musk, I mean, it's moment of truth, because bottom line is the longer he stays in Doge, every day the brand crisis for Tesla expands and gets worse and worse. And that's why Tesla's become a political symbol, a debacle for Tesla shareholders with such great future. But it comes back to like, this is a fork in the road for Musk when it comes to Tesla. He either leaves Doge, takes a huge step back, or this will be, I think, some pretty dark times.
Let that sink in, as he might say.
The NASDAQ 100 is set to enter a bear market today as the tech sell-off continues its slide amid the trade war. Our next guest has been talking with CEOs in the tech space about how the tariffs could impact their businesses and what they're expecting from the administration going forward. I want to bring in Dan Newman. He is Futuring Group's CEO. Dan, great to have you here. Tell me what executives are telling you in the tech space.
One of the fun parts of my job, but not so fun this week, is having the opportunity to spend a lot of time providing feedback and also listening to the CEOs. And I spoke to half a dozen large cap and a few small cap tech CEOs. And one of the things that every one of them was going into the week was really hoping to get some certainty this week. And that was one of the biggest surprises, was instead of coming out with more certainty, we actually have entered a period where all of them feel we are less certain. A lot of them feel that what Trump and Lutnick and the administration did was more of an opening salvo. And they really think it's going to come down to 10, 15 of our world's largest trading partners. There's a lot of noise about all these smaller nations, but they basically feel that there is going to be more negotiation. We're seeing the back and forth today with China. Spoke to Bill McDermott at ServiceNow, and it was interesting to hear his perspective. You know, he actually said he's zeroing in on what he can control right now. And if you're a hardware company like Apple, you don't have as much you can control. But for someone like them, he's looking at the situation and saying AI is actually going to be this great deflationary enabler right now. So as companies are kind of tightening their belts, they maybe look to start slowing spending down. He sees a company like theirs as one of the biggest opportunists because companies are going to start spending on AI because it could basically maybe cap or slow down OpEx, start to automate more processes and prepare companies for a time of uncertainty that we are certainly going to get for at least the next few weeks.
Dan, the primary theme in markets has been AI. In the last month or so, we've seen Microsoft seem to go back and forth on their CapEx spend intentions. When we look at the earnings transcripts for the data center theme, we see backlogs and continued investment. Has that changed, and what is the outlook for data center spend?
Yeah, that's actually a really good one. I spoke to one of the CEOs involved in Stargate, and one of the things he actually said to me is that he believes the enterprise AI trade is somewhat tariff-proof. Now, that's really interesting to me because, of course, you can look at all of we heard some of this, we don't know all the certainties on semiconductor tariffs, but effectively the build out, his perspective from the conversations he's had, and my conversations with CEOs have been very similar, is that these companies that have massive operating leverage, the Mag 7, some of the largest software companies, they actually have the opportunity to look at this drawdown as a moment to double down on R&D and position themselves, knowing that AI is going to be the product that will accelerate coming out of this. They're not certain of when they're going to come out of this, but they basically told me the CapEx is locked in. And so the near term on sort of these CapEx plays for big AI buildouts seems to be pretty secure. I'm much more confident, and from all the conversations I had, I remain much more confident in the enterprise side of the trade. The consumer stuff, though, is very opaque right now.
I could ask you a million more tariff questions, Dan, but we only have time for one more, and I have to get to a story that would be headline news if it wasn't for a day like today, and that is this Intel TSMC deal. Talk to me about the deal. How bullish are you on what this means for Intel moving forward, and were tariffs part of the kind of final push for that deal?
Yeah, I'm still a little skeptical. I'd like to get a little bit more backing on these sources. Having said that, we need the U.S. fabless companies, the design companies, the NVIDIAs, ARMs, Broadcoms, to lean into Intel. All these companies love working with TSMC. They basically allowed TSMC to raise prices endlessly, and it still hasn't caused this sort of mass exodus to the doors. We need to produce here. We need to bring the IP transfer here. And I think the partnership can certainly speed up the process of getting those big volume AI chip companies and device companies to use Intel foundries. And 18A looks better. So I'm feeling positive about it because this is a big play. It is a U.S. play, and it could be helpful in terms of getting some confidence back in U.S. manufacturing of leading edge chips.
All right, Dan Newman, got to leave it there. Thank you so much. Appreciate it.
Thank you.
Joining me to discuss the sell-off and everything going on in markets today and this week, we're joined by Joe Brasuelis. He's the chief economist at RSM, as well as Corey Johnson, Epistrophe Capital Research chief market strategist and the host of the Drill Down podcast. All right, where to begin? We're saying just before we came on, there was a jobs report this morning, which I barely remember at this point.
It's been a day.
It has been a day. It's been a couple of days. Corey, let's just start with the market action overall. What you've thought of the last 2 days, really going back to Wednesday afternoon, because I will admit I kind of came into Trump's announcement and I'm like, he'll say some stuff, it'll probably be fine. And it has felt like Brexit, COVID, a couple different things all tied into one.
Yeah, I think that there was some hope that there was a plan behind this. And the plan might be negotiating tool, lots of threats, then back away. And we've heard some people who know a lot about a lot saying that that's exactly what was going on. Mm-hmm. But what we've seen here is there doesn't seem to be a plan. And the plan seems to be slap tariffs left and right with the true belief, is just what President Trump told us running for office. He believes the tariffs work. And all the evidence we have from 150 years of economic history is that they don't work. And they do the opposite of what the intended goal here is, if in fact the intended goal is to increase the power of the economy, to increase manufacturing in the United States. I think the market has figured out, wow, this guy really means it. They're just going to they're going to raise inflation, they're going to slow down the economy, they're going to send us running towards a recession, and they don't want to hear from anyone who disagrees with it. And that's where we're at, and I think that's what the market's reflecting right now.
And so, Joe, looking at just the economic impact that we think may come to pass from what we've heard so far, how did you look at it in the initial hours on trying to guesstimate an overall tariff rate or what this would mean for GDP, inflation? Like, how have you looked at what your forecasts and assumptions were and tried to revisit them maybe in the last 2 days?
We thought the effective tariff would end up around 20%. It's 23%. I thought we'd end up with a 12 to 15% average weighted tariff. That's a little under 19%. So in many ways, it landed sort of where we thought it would. But the problem is the execution of it, that nonsensical introduction.
Madagascar?
Yeah, of the formula. These aren't reciprocal tariffs. These are punitive tariffs. And it's the loss of credibility on the part of the administration, the loss of confidence of markets in them, which is what's causing this. They really need to step in and say, hey, we have an off-ramp here. This isn't a leverage negotiating situation. Or I love the Dodgers, they bring in the high leverage reliever. They got to get the high leverage reliever off the bench and get it in the game because we can't go on much longer.
But here's what's different about Trump 2.0, right? Is that there aren't relievers there. There aren't different, there aren't, it does not seem that there are voices in the administration, as there were the first time when Trump was president, voices that can disagree. Voices that can say, interesting idea, what about this? Everyone's all in the same boat here, and they're all going the same direction. They're all leaning on the same side, if I can stay on that metaphor.
I have to admit, earlier today, I'm like, where's Gary Cohen? And I remembered, oh, that's right, he's not there. Right, and that's the problem.
Yeah, I was going to say, is it about the agreement or not, or is it just simply the presence of folks like Gary Cohen, like Stephen Mnuchin, who really had the trust of the market? And right now it feels like there's no one in that administration that an investor can look to and say, oh, okay, that guy's on TV, he'll probably call
We're here amongst friends. Well, this is a Wall Street.
Yes, we are.
We are, right?
Just tens of thousands at home as well.
We all know who Howard is. He's not the guy, right? What we need is Besson to step up.
You probably know him as long as I've known him.
Yeah, no, we all know Howard. He's not the guy, right? Keep sending Peter Navarro out on television every morning.
He's not the guy.
You're going to get the same outcome. We really need Scott Besson to step up and play a more pronounced role to calm and soothe nerves, or again, this is just going to continue to go on. You know, we were talking just before we started the show. We're not that far from them stopping trading at this point.
That's right.
That's how far down we are.
Well, we don't have, to get to my point, as we talk about this White House, we don't have a team of rivals. No. Right? We've got a team of sycophants. We've got a team, but they agree very strongly on the same things. And it does seem that a good part of America believes that whatever the White House tells them and really wants to believe that those things are true. And so and we have for lots of interesting reasons, we have a media echo chamber where they're not hearing the voices that everyone else is hearing. And people are hearing the voices that they want to hear. So they're hearing cheerleading from the media outlets they want to be on, from the places on X that they want to be on, from the, you talk about, this is already surgical decisions here. These are the people who celebrate cutting jobs with chainsaws. And there's no sort of notion that nuance is a good thing.
Right. I mean, it was very clear to me when they introduced the Madagascar equation that they have a very low evaluation of what Wall Street is. And we all figured it out within about an hour.
Right.
And we could tell that this just didn't sum up. Right. And then that's what really set the tone for Thursday into Friday.
Yeah. Well, and speaking of that view on Wall Street, Corey, I want to get your thoughts on what's the level, if there is one, on the S&P or whatever you want to look at, where they may actually cry uncle. Because the biggest change from an investor standpoint in Trump 2.0 is that the stock market is not only the scoreboard, a scorecard as it was used the first time, it is now actively viewed as something to ignore because those guys doing all this that we're looking at on the screen, for whatever reason, are now viewed as the folks who don't understand what we're trying to accomplish.
Look, I think that what's interesting here is, and as I look at my portfolio and I'm looking at the names that I cover as an analyst, and I've done a lot of work in crypto. Right now, that's I'm not suggesting anyone invest in crypto, but I've been saying for the last couple of years that Bitcoin is not in fact a store of value; it is a store of speculation.
That's right.
And so when I look at all of the Nasdaq-y names, the names that I cover in technology, in semiconductor software, data centers, AI, hardware, that those stocks are stores of speculation. I spent the beginning of this week, I don't want to go too deep this rabbit hole, but I spent the beginning of this week at an optical fiber communications conference. And it was as bullish it was a technology conference, it was not a stock conference. But it was as bullish a place as I have been in 20 years. Every company told me they were pushing away orders, they can't get enough money to build their factories fast enough to build this. They're talking about revenues in 3 or 4 years of 400% higher or more. I talked to a CFO of a publicly traded company, told me off the side, says, you'd have to be an idiot not to be in this business and just killing it right now because the orders are coming in the door. Those stocks are down 20% this week.
Yeah.
And it's because they are stores of speculation.
Yep.
And so right now the speculation is coming out of the market, and all the air is coming out of the market right
And the retaliation put to the United States on China today was what you'd expect, goods and rare earths. When we get to the portion of the play where the European Union starts to retaliate,
Monday?
Yeah, probably Monday, maybe
Right.
Tuesday at best. It's going to be the banks, it's going to be financial services, it's going to be airlines, it's going to be tech. And I'm telling you right now, market is not priced that in. They fundamentally think this is just a repeat of 2018.
Yeah.
So there's a lot more damage that could go on here, which again is why it'd be a good idea if in the next hour somebody came out and said something, well, rational, so we can at least calm down, because someone's going to have to step
Elon?
up.
Who's
I'm not counting on that guy.
Who's the
yet.
rational?
I think
Who's the rational person in that?
I think we named a couple of folks that aren't in the administration right now that I think investors
Look,
want to hear from.
I think you can put Kevin Hassett over on Fox Business News
We'll
within
see.
the next half hour and calm things down. It wouldn't take much.
Yeah. All right, if a surgeon operates needlessly on a patient, it's medical malpractice. So if a policymaker destroys value, endangers livelihoods, and lowers living standards, is that economic malpractice? Joining us now to make the case is Yahoo Finance's Rick Newman. Rick.
It's economic malpractice on an unprecedented scale. Would like to say hello to Joe Bersalis there. How you doing, man?
Hey, Rick, good to see you.
So what President Trump said yesterday, using this medical metaphor, is one of the most idiotic and regrettable things that any president will ever say in American history. And just to remind people who might have missed it, Trump said, referring to his tariffs, the operation is over. The patient lived and is healing. The patient will be far stronger, better, and more resilient than ever before. This is complete nonsense. So just to break this down, number one, Trump says the patient, the U.S. economy, was sick and in need of surgery. That is false. The U.S. economy was doing well before Trump took office. Now it actually is sick because of Trump. And the patient is not doing well. The patient is hemorrhaging. That is what is happening in markets, and markets are only foretelling what is going to happen in the real economy. There is only one person in the world who doesn't realize what a disaster this is, and that is Donald Trump. There might be a second person you could finger, which is Peter Navarro, his trade advisor. And as you guys were discussing before, who might be the fall guy for this? If there's anybody, I think it might be Peter Navarro, who already went to prison once on Donald Trump's behalf and might take the pain again. We can only hope that that is what Trump does, that he finds a scapegoat and says, this was all somebody else's idea, I'm calling the whole thing off. Because if he doesn't, as Joe and basically every other economist in the world knows, this is a nightmare.
Rick, you make the case of how the president's messed up, but he has made the case that we've been being ripped off by the tariffs other countries have been charging us. And I don't know if you've made the case that every country out there that we're now charging tariffs to, that the American consumers will be paying for, have been ripping us off. But isn't it the case that some countries have been ripping us off?
I don't think so. I think some countries have been cheating on trade. I mean, I think there are a lot of people who would say, yes, China cheats on trade. It uses a government-run economy to subsidize the big state-owned enterprises and other things like that. Yes, we do have a problem with people and communities that used to rely on good-paying manufacturing jobs that aren't there. But blowing up the whole economy is not the solution. To go back to the medical metaphor, you don't operate on the entire body from head to toe to fix a pimple or something. I mean, address the problem in a targeted way. And there are tons of ideas for how to address these problems in targeted ways. There are ways to crack down on China's cheating. Other countries do it as well. It's too complicated to get into in one segment, but there are many ways you can do that. With the places that we need better paying jobs for people in America who do not have college educations, there are also many ways to address that problem. We need more tradespeople. That is not assembly line workers making socks that we don't want to pay for in America. It is people, it's plumbers and welders that we need to do jobs that are good paying jobs. Many companies need skilled workers that they can't get enough of, and they're trying to line up with local government and state governments and say, here are the types of workers we need. Can we get these people in the pipeline to get these skills? All these types of things. Do that kind of stuff. Why make everybody 25 or 30% poorer in order to bring back 100,000 automaker jobs? This is insane.
All right, so the late great Herb Stein used to tell us that if something bad goes on long enough, it usually comes to an end. How do we get out of this, Rick? What's the way forward?
Well, Joe, I mean, you would be the one who could put numbers on this. If Trump were to reverse this quickly, we could get out of it without too much damage. But the longer these tariffs stay in effect, the more this damage becomes irreversible. I mean, to go back to the metaphor, Trump is not going to kill the patient. He can't kill the whole U.S. economy. Thank God. I mean, the U.S. economy will survive all of this in some form. But we're going to survive with less. I mean, this is demand destruction and value destruction. You don't just automatically get it back if it stays in place long enough. So I don't know. I mean, this is a real test of how responsive the political system actually can be when you have a man-made crisis on your hands. And much of this is unprecedented. I mean, Trump has figured out that he doesn't have to answer to anybody on tariffs. He knows that he doesn't have to run for re-election unless he tries to. So he doesn't have to answer to voters in that way. So we are in a predicament here. And this all comes down to how hard-headed is Trump actually going to be?
President Trump's steep tariffs forming a challenging landscape for the central bank. Fed officials left with the crucial task of working out the impact of tariffs on inflation. Meanwhile, the path for interest rates remains uncertain. University of Pennsylvania adjunct professor of finance and former president of the Federal Reserve Bank of Cleveland, Loretta Mester, joins us now with a closer look. Loretta, good to see you. First and foremost, Loretta, want to get your take on Liberation Day. What did you make of these new tariffs, Loretta? What do you think the Fed makes of them?
Well, thanks for having me on. The tariffs are going to affect both parts of the Fed's mandate, full employment, maximum employment, and inflation. And it's going to affect both parts over different time horizons. So that's what makes this particularly difficult for the Fed. We know that tariffs act like a tax, so it's going to reduce growth and weigh on the growth side, which means the employment side of the mandate. And then, of course, it will have at least a temporary effect on inflation. The question of whether it will be more meaningful in terms of inflation, more persistence, is really going to depend on, firstly, whether there is a lot of retaliation and then back and forth and tit for tat, which means that instead of being one shock, it's multiple shocks, kind of like what we saw with the supply shocks during the pandemic. But also crucially on whether inflation expectations remain anchored at levels consistent with 2%. 2% inflation. And that is probably a question at this point, because we've already seen some of the inflation expectation measures move up. If inflation becomes embedded and people see higher prices because of the impact of the tariffs, they may start believing that inflation is moving back up again, even though it's come down quite a bit from the peak. And therefore, it can become a more persistent inflation problem. We didn't see that under the first Trump administration. In fact, inflation remained low, didn't move up. And what the Fed ended up doing is having to address a weaker growth economy, and therefore it started cutting rates in September of that year, so in 2019. So again, we don't really know how this is going to play out, but I think there's higher risks this time that the tariffs could be inflationary, and that's something the Fed's going to have to keep in mind in balancing both parts of the mandate.
Loretta, the market seems to be of the mindset that the Fed is on hold for a little bit longer, probably not going to cut rates again in May. Jerome Powell, though, to the surprise of, I think, a lot of many market observers, brought back the transitory word when describing inflation at the last press conference. Do you feel that some of these pressures that we might see from tariffs are in fact inflationary, that the Fed could be pausing but leaning more to the dovish side of wanting to cut again? Or are you worried that prices are going to remain stubbornly higher for longer?
Yeah. I mean, even before the tariffs, there were signs that inflation was remaining a little more stubborn than the committee would like, which is why they paused in January. So if you couple that with now this potentially, inflationary shock from the tariffs, I think there's upside risk to the inflation forecast. Now, of course, they'd like to be able to look through the one of tariff impact on prices. I mean, typically the textbook would say you have tariffs, prices move up, and then inflation moves up temporarily, and as those prices work through to when, there's a new level of prices and inflation comes back down. I don't think they should put all their money on that bet. I think they should be very carefully looking, and I think the chair said this, at inflation expectations, because if they become unanchored, then you have the worst case scenario where you have weak growth and you have inflation moving up, or at least not coming down. So I think they are going to be, being on hold, if you will, but that's really about balancing the risk, right? They're trying to balance the risk of inflation pressures moving up at the same time the economy weakening. And so being on hold at where the rate is now until they're convinced that inflation expectations are well anchored, and then being ready to address a potential deterioration in the labor market seems like a good strategy. The danger with the strategy has to do with how that's communicated, because it could end up being communicated as, see, the Fed was late again, they remained on hold too long, and therefore now they're cutting, but they should have cut earlier. But no, it's really a strategy to balance those risks, to make sure that inflation doesn't get out of hand. And I'm hoping that they begin to communicate more about the objective function and their objectives and reaction function, so that people will understand why they're following a wait and see. It's not because they're asleep. It's just they're really trying to balance what's going on between the real side of the economy, employment, which is part of their mandate, and inflation, which is a very important part of their mandate as well.
Loretta, I'm just curious, how would you characterize the state, the health of the American consumer right now, Loretta? Because, I mean, you've seen the recent sentiment surveys, not good, Loretta, and that was before Liberation Day. So how would you characterize it? How are you thinking about it?
Yeah, I think the consumer is nervous. I mean, I think, as a lot of people are, about what's next. And, there's a lot of uncertainty, and there was even before we knew what the tariffs were, there was so much back and forth on the policies that the uncertainty around it just makes everyone pause and just say, okay, I better not spend a lot of money now because I don't know what's coming next. I better be cautious. And add to that, the uncertainty over the DOGE cuts and what does that mean? There's a lot of people affected by that, not only federal workers, but people who, work with the federal workers. Universities are affected because their funding is getting cut. So there's a lot going on in terms of the policies here. And even though there's some, there was some kind of hope at the beginning of the year that we'd see the deregulation and, being positive for growth, and perhaps tax cuts being positive, I think the uncertainty around the current policies and the tariffs have really, reduced sentiment. We started out the year with very high levels of sentiment, certainly after the election, and now we're seeing very low levels. And so I think the consumers are rightly, sort of, let's pause a little bit on discretionary spending, and let's wait and see, how, healthy the economy is before moving on. And you talk to businesses and they say the same thing. All the businesses I used to talk to and now continue to talk to tell me the same thing, which is, just tell me what the rules of the game are. I can play the game. I can run my business. But if I don't know what the rules of the game are, then I'm going to have trouble and I'm going to be on pause. And that's what businesses are doing now. They're pausing some of their projects because they don't really know what's coming. And so that's how this can, not only the tariffs' direct effect, but the uncertainty around policies coming can affect the economy in a negative way. And I think that's what we're living through right now.
Loretta, great to have you on the show today. Thanks so much for your time.
Thanks for having me.
While Trump's tariffs wreak havoc on Wall Street, the new duties also paving the way to reshaping global trade. Here with more on the fallout from the Trump's trade policies, we have Ian Bremmer, founder and president of Eurasia Group and G0 Media. Ian, good to see you. So a question top of mind for investors now, Ian, is what comes next with these new Trump tariffs, and specifically how our trading partners are going to react. Are we going to see negotiation? Is it going to be retaliation? We had a guest on earlier in the show, Ian, who said, listen, he expects negotiation with what he described as he's looking for symbolic retaliation. Is that how you see it?
Depends on the country. But before you focus on the next things, let's recognize that, this is pretty heady stuff. You're talking about the U.S. entering an entirely new economic order, leading one. This is a complete undoing of a multilateral free trade environment. The world's largest economy, most powerful country, is putting unprecedented tariffs on everybody we've not seen in our lifetimes. So, I mean, yeah, there's going to be negotiations. There'll be some capitulation. There'll be some places that'll go full tit for tat. Most won't. But even if everyone was in deal mode, you would still be in a new world order. Because, I mean, remember, there are a whole bunch of countries out there where the United States is actually running a surplus with tariffs that are incredibly low. And Trump said, even on those countries, 10%, right? I mean, you've got countries out there that are incredibly poor, that provide commodities that America needs and can't get other places. They have no ability to buy American goods. And Trump said, 10%, right? So, I mean, the reality is that the purpose of these tariffs is not just to drive deals. It's also to force a reordering of how we think about global investment and make people recognize that the United States is where you need to be if you want to be doing business with the U.S., and there's going to be a cost to that.
Is this the end of globalism, Ian, or do you think, is there the potential for the rest of the world to kind of throw up their hands and say, we don't really want to deal with the U.S. in the same way that we have done in the past, and we're going to forge our own trade agreements, and if America eventually wants to be a part of them, that's all great, but if not, then we're going to do business with each other and see how the U.S. likes it?
Well, there are two ways to answer this. I mean, the negative response is that for the last 20 years, there have been a lot of people that have talked about a de-risking from China because China doesn't have rule of law, they're opaque, the state makes decisions that can be arbitrary and capricious, they don't respect intellectual property, all of those things. So everyone's talked about how they can de-risk from China. I have had so many phone calls with leaders of governments and with companies all day today about de-risking from the United States. So you are now, that is the new term of art, and countries and companies around the world are going to find ways to try to reduce costs and get risk out of their system by having less exposure long-term to the U.S. market. That's the bad news. The good news is that the United States is in a position of great power. And there are lots of ways that you can't de-risk from the United States. So look at the hyperscalers, look at the big technology companies. The Europeans are not going to now say, how do we go crush Meta, or Google? And why not? Because they can't replace it with anything. There's no substitution effect. The Japanese can't say, oh, let's go do a deal with China and coordinate with the Chinese against the Americans, because the Japanese can't leave the American security umbrella. So there are a lot of places where you just need to keep working with the U.S. no matter what. And of course, the size of the American market is important. It's not as big as the European collective common market, but it's still pretty damn big. And so ultimately, there are a lot of countries that are going to try to find ways to get along with this new environment, however arbitrarily and unilaterally driven by President Trump.
Ian, what about China specifically? Because I saw headlines today, they're already talking countermeasures if the U.S. doesn't cancel these tariffs. What could countermeasures actually look like? I mean, what do you actually expect to see from Beijing?
Well, I'll tell you what I don't expect to see. I don't expect a TikTok deal to get approved by the Chinese anytime soon, because why would they be making a give to the U.S. when Trump is throwing a three-handle on top of these new tariffs, and he's saying, well, maybe I'll take a point or two off. I mean, we are very, very far from a breakthrough from a U.S.-China, sort of new Nixon environment, no matter how many people are speculating on it. But the Chinese economy is performing poorly. They weren't going to hit their 5% growth number even before Trump came to town. They're having huge problems with consumer demand and consumer sentiment. They're having huge problems with regional indebtedness, with all of their provinces essentially in receivership. And that gets much harder when the Americans not only hit China, but also hit all the other countries that are passed through from Chinese exports into the United States, like the Philippines, like Indonesia, like Vietnam, right? So when you add that up, The Chinese, yes, they need to respond, and there will be a response. There will be retaliation, but it will not be tit for tat. Where the Chinese can really retaliate is by taking advantage of American lack of interest in leadership. The fact that the Americans want to be unilateralists, the Chinese will be like, great, you want to pull out of the Paris Climate Accord? We'll be the drivers of post-carbon energy transition. We'll be the most important country at the COP summits going forward. U.S. wants to leave the World Health Organization? Great, we'll be the most important country in the World Health Organization. We'll call the shots there. If U.S. wants to stop paying dues for the UN, great. We'll be the most powerful country with influence over the United Nations. U.S. wants to stop spending on USAID, great. We'll be the most important across the world in the global south. Myanmar has an earthquake. Remember when Indonesia had the tsunami? The Chinese failed. The Americans had boots on the ground. Myanmar has a massive earthquake and thousands die. The Americans do nothing, and the Chinese are on the ground. So reputational power, soft power, diplomatic influence with countries around the world, the Chinese see themselves as long-term beneficiaries of what the Americans are doing right now, and that is an opportunity for them.
Long-term Treasury yields have been coming down, and I'm sure the President and Treasury Secretary are happy with that. Any thoughts at all about whether China, which has a pretty significant stake, holdings in Treasuries, would they risk hurting themselves to unwind in a dramatic fashion some of those Treasuries to try and maybe push bond yields back up as a sort of retaliatory move?
Your question was in a dramatic fashion, and the answer is no. The Chinese are thinking long term. Their responses are going to be incremental. They don't want a crisis. They want to see how this shakes out for their own economy and as well as for their relations around the world, and they want to move carefully. The term for it in China has always been, when you're walking along a river, when you're crossing a river, cross slowly and feel the stones with your feet because you just don't know where you are. That's what they're going to do here.
Ian, always appreciate your time and analysis, sir. Thanks for joining us.
My pleasure.
Stocks plunging today. We know the worry. It's tariffs. What does it mean for the U.S. economy? What it means for the global economy? You're talking to clients, Ed, on a day like today. What are you telling them?
Well, I think it's too late to panic. I mean, clearly that's the knee-jerk reaction of anyone that's in the market is with this kind of sell-off is how much lower can we go, and is it too late to panic? I think it is. I think there's some really interesting values occurring here because I think we've seen some panic selling in some areas of the market for sure. It's not broad-based, but it's painful enough. But this doesn't mean you have to rush in to pick up these bargains simply because the reality is the issue of tariffs and its impact on the economy. It's going to take a while to sort it out. It's ironic that so many people thought that yesterday, so-called Liberation Day, would be peak uncertainty. That once we got all the specifics on it, we could kind of like breathe easier. But I don't think that's the case at all. I think there's still plenty of uncertainty about how all this plays out. Will there be negotiations that bring these tariff rates down? I think there will be. Will there still be some issues with retaliation by other countries? I think there will be. I think it's going to be messy, and it's probably going to be hanging over us for another couple of months, and then we'll start focusing on the extension of the 2017 tax cuts.
Ed, I'm wondering, where would you be looking for potential bargains on a day like today? Josh mentioned how the energy sector is a big loser, but they have actually done really well this year.
Yeah.
Do you see more upside there? And then what about big tech? They have gotten crushed for all of this year. At what point do they finally bottom?
Yeah, well, when the current bull market started back in October 2022, it took us a couple of weeks to recognize it. In early November, we were recommending overweighting the technology and communication services. We were recommending overweighting financials and industrials. And from a fundamental perspective, they still look pretty good to us. Barring a really terrible recession, we think a lot of these areas are going to continue to grow. There is a lot of onshoring going on, and that's good for industrials. The financials are in very good shape. They're not really exposed to any sort of major financial calamity here, and they have lots of capital. And then the technology companies actually have earnings. This is not the tech wreck. So I think there is sort of a knee-jerk fear that this is going to turn out to be like what happened in 1999, 2000, and kind of a big bubble bursting. But I don't see it that way.
Ed, let me get your take on what we're seeing in the 10-year. You know, I'm looking here, Ed, we're back to 405. Is the message that's sending investors, Ed, is it that, okay, recession fears right now outweigh inflation fears? And two, I'm curious, where do you see the 10-year headed from here?
Yeah, I think you're right. I think clearly the straightforward interpretation is the bond yield has come down on the tariffs. And we all know that the tariffs could have an inflationary potential, and that in turn could create stagflation, because consumers consumers who voted for Trump, many of them expected that the first thing it would do would bring prices down. Instead, we're going to see prices up. So that could depress consumer spending in the second half of the year. And you're right, the bond market seems to be focusing more on the weakening economy rather than on the inflationary potential. I think there's still a belief that the Fed's going to come in and save the day, but I don't see that happening at all. I think the Fed is in no rush to bail out this misguided trade policy coming out of the administration. I think they're going to say, look, we can't move right here. We can't lower rates because we're going to have a bout of inflation. We think it's going to be transitory, but we can't be certain about that. And so I think the Fed is going to hold off giving us any sort of relief.
Yeah, I was going to ask you about that as well, Ed, with regards to the Federal Reserve. When do they feel compelled, do you think, to start lowering rates again? How high would the unemployment rate have to go? And is there the risk that they wait too long to cut at a time where we know they're in an easing cycle? So it's not as if there's the symbolism of it's the first rate cut. They've cut rates already a couple of times. It's just a pause right now.
Yeah, it's a pause. And last we heard from them, they were still kind of in a dovish pause, because they were saying that they're in no hurry to lower rates. They didn't say we're in no hurry to do anything. They didn't say we're in no hurry to raise rates. They said we're in no hurry to lower rates. So their heads are still clearly focusing on lowering interest rates here. But the reason they're in no rush is because the economy up until now has actually looked pretty good, and inflation was still above the 2% target. Now what we can expect is that inflation will look worse and the economy will look worse. So scratch your head, and what do you do with that dual mandate? And I think for the sake of their credibility, they can't let inflation get out of hand the way they did in 2021, 22, 23. So I think they're going to say we can't rush here because we got an inflation problem.
Ed, tomorrow, jobs report. Curious what you expect there. You know, Ed, really the labor markets look broadly stable, right? I mean, it's sort of cooling, not crashing. That's been the mantra. But what do you see tomorrow, and what do you see ahead for the labor market, Ed, given all the uncertainty we're dealing with here?
Well, that's the pity here, is that the economy actually is in pretty good shape. The labor market's in very good shape. The unemployment rate is 4.1%. But we are clearly seeing announcements of layoffs increase as a result of the Doge boys, as I like to call them, kind of announcing that they're going to reduce payrolls at the federal government level. We aren't actually seeing that in initial unemployment claims. So it's not clear that what they're saying is what's happening, because the courts, of course, have held them back on cutting back actual employment. But on the private payroll side, I expect something like 150,000. That will be consistent with what we just saw with the ADP. So it's going to look fine. It looks like the economy is doing fine. But we just had the purchasing manager survey for non-manufacturing, and we did see a rather sharp drop in that employment index. So I think employers are just as confused and concerned and fearful about the consequences of these trade policies, and they're going to kind of stop hiring until they can figure out what's going on. I hope they don't start firing.
Any chance at all, Ed, that we see a noticeable enough deceleration in wage growth in the jobs report tomorrow? I mean, if average hourly earnings don't rise at the type of level that would spook the markets about inflation, you could argue that maybe that tips the balance a little bit for the Fed to be more inclined to ease sooner rather than later.
Well, it's possible, but I think at the end of the day, the Fed really focuses on the consumer prices, the PCED, the personal consumption expenditures deflator, and that looks like it started to heat up last month. And given what the tariffs are likely to do to auto prices and auto-related prices, we are likely to have an inflation problem on the PCED, and that's more important than what happens in wages. And of course, if wages are moderating, but price inflation is increasing, real wages are going down, that's going to depress consumer spending, hence we get stagflation.
Ed, always great to see you. Always great to have you on the show. Thank you, sir.
My pleasure. Thank you.
Well, in a response to President Trump's broad tariffs, Business Roundtable CEO Joshua Bolten wrote the tariffs, quote, run the risk of causing major harm to American manufacturers, workers, families, and exporters. Damage to the U.S. economy will increase the longer the tariffs are in place and may be exacerbated by retaliatory measures. According to a report from the Wall Street Journal, corporate America is concerned about the president's trade policies. For more, I want to bring in Nick Timrose. He's the Wall Street Journal's chief economics correspondent. Nick, fantastic to talk with you this morning. I know that you have been speaking with corporate executives. You obviously cover the Fed very closely. I just want to get a sense. Have you heard anything different from corporate executives since these tariffs were announced last night? And what can you tell us?
Well, if there's any good news, it's that you now know, what the cards are on the table, and whatever uncertainty was there before, obviously it hasn't gone away, but you now kind of know what you're dealing with. I think the problem is that nobody likes what they're dealing with here. These are larger tariffs than what most people expected. These are larger than what Trump himself had run on during the campaign. You recall he had run on a 10% across the board tariff and 60% on China. It seemed like China, as was the case in the first term, was going to be the focus of trade policy changes in the second term. And so these tariffs announced yesterday, Madison, were just much larger than what people, even at the more pessimistic end of things, had been expecting.
Nick, where is the voice of the business community in all of this? I mean, I remember during past presidential terms, if there was something that the business community didn't like, they were quite vocal about it, or the Chamber of Commerce was quite vocal about it. Are you surprised that we're seeing it show up negatively in the survey data, but we don't hear a louder voice from the business community?
Well, I think you look at some of the other things the administration is doing, targeting universities that have taken positions that maybe the administration doesn't like, going after some of these big law firms. And so you may see a culture of fear. Nobody wants to be the first to file the lawsuit challenging the constitutionality of these tariffs. Nobody wants to be the one to stick their head out and have it get cut off. There could be some of that here. I think there's also been just let's see what this is before we go DEFCON 5 and fighting it.
And you had a piece out this morning in the Journal on how tariffs aim to create a new world economic order. Nick, it's not just the U.S. that is at risk of entering into a recession because of these tariffs. What are your sources telling you about the risks globally for an economic slowdown?
Well, it really isn't about sources at this point. It's about you look at what the markets are doing right now. The administration has been saying short-term pain for long-term gain, but the market doesn't see it that way. The dollar is down, bond yields are down, stocks are down. People are talking about higher inflation this year, but with more rate cuts from the Fed later on to cushion the hit to growth. I think what you see here is Wall Street going through the 5 stages of grief. We're clearly out of the denial stage now, but whether we're in anger, bargaining, depression, I think it depends on your perspective which one you're in. We're not at acceptance yet. That's what we're seeing happen this morning in the markets.
So Nick, really quick, if we're going through those 5 stages of grief, what does it take for the corporate executives who speak to you anonymously and say that they are fed up with these policies to be a little bit more vocal in order to get the president to pause on some of these policies?
I think that's a great question. I don't think we know what it's going to take. And we're sort of in uncharted waters here.
Yeah.
So we'll just have to wait and see. I think that's the right question right now is people are asking, where's the Fed put? I think the question is, where's the White House put? At what pain point do members of Congress and businesses begin to put pressure on the White House to negotiate or do whatever is going to happen here?
Nick, got to ask you about the Fed, my favorite Fed correspondent. We're hearing from Powell tomorrow. How do you think he's going to respond to this, and where do you think this puts the Fed moving forward?
Well, it puts the Fed in a very difficult position. That much is clear. As to what Powell says, he's been very careful recently. There isn't a big incentive for the Fed right now to be drawn into something that is the administration, putting out these policy actions that the markets don't like. So the Fed at a certain point will have to react to weaker growth. But if inflation's going up, it gets awfully harder for them to do that. One other point I would make is that, what do rate cuts accomplish? They help interest rate sensitive sectors of the economy like housing and autos, but those also happen to be two of the most trade affected sectors. So people here thinking that the Fed can run to the rescue, I would sort of curb your enthusiasm about that. If housing, costs to build houses, costs to put together cars are going up, I don't know what interest rate cuts are going to do to cushion that hit.
We're going to produce the cars and ships, chips, airplanes, minerals, and medicines that we need right here in America. The pharmaceutical companies are going to become roaring back. They're coming roaring back. They're all coming back to our country because if they don't, they got a big tax to pay.
President Trump granting pharmaceuticals an exemption to his hefty reciprocal tariffs alongside semiconductors, lumber, copper, and some minerals. But the industry is already bracing for that to change, with Denmark's benchmark index entering into a bear market amid concerns about Ozempic maker Novo Nordisk and potentially some tit for tat there. I want to bring in Stephen Ezel. He is Information Technology and Innovation Foundation's VP for Global Innovation Policy. Stephen, great to have you here. Pharma, somewhat safe for now? Where is it heading in your view?
Yes, pharmaceuticals were exempted today. However, we have been continually led by the Trump administration to expect that the drug industry will see tariffs at some point in the future. There is word out that the administration may open a Section 232 investigation into pharmaceutical imports in the United States. Section 232 investigations are opened under national security grounds. So while the industry is out of the woods for the moment, we may see tariffs in the future. It should also be noted, as your viewers see today, that while the pharmaceutical industry won't experience tariffs directly, there is no industry, business, or citizens that will escape unscathed from these tariffs today. In particular, these tariffs are going to make drug innovation and drug manufacturing in the United States more expensive. If you think about it, to innovate drugs, we have to have very sophisticated equipment like gene sequencers or scanning electron microscopes. To manufacture drugs, we have to have vacuum pumps and biosafety cabinets. These inputs and components come from suppliers all over the world. So even though the pharmaceutical product will be not exposed to the tariff, all these inputs and components will, and that's going to make U.S. pharmaceutical manufacturing going forward less globally competitive.
When do you think the U.S. consumer will start to recognize? I mean, they're coming for our Ozempic and our Botox, right, and a significant amount of the generic drugs. What's your expectation for when Americans could start to feel some pain?
Well, I think that as companies see that their cost of innovation and manufacturing are going to rise in the future, we'll see that starting to flow through into prices for a wide variety of products almost immediately, and I would not expect this industry to be any exception.
And to that end, what are you thinking in terms of the potential of retaliation with the likes of Novo Nordisk, for example, and how that could impact some of those prices for goods?
Well, the Trump administration in this case is like a chess player that only thinks on the offense and not looking at what the retaliatory countermeasures will be. And one thing we have to recognize as well is that even though the Trump administration hasn't imposed tariffs on these pharmaceuticals, as other countries look at the suite of tariffs they may put in place to retaliate against the US tariffs, pharmaceuticals could very well be one. So this is going to harm American companies' ability to sell their products into foreign markets going forward. And I think if you asked about, Denmark in particular, Novo Nordisk, I think what we're seeing in these cases is a recognition that, the average American household is going to pay $3,000 to $5,000 more for goods by the end of this year as a result of these tariffs broadly. And that is going to have an impact on all sorts of downstream or discretionary purchasing in the United States. And this is why every industry, including life sciences, is seeing the hit from these tariffs today, because the economy is going to decrease. It was pointed out that as a result of this, Denmark may tip into recession. But global GDP is expected to decrease by 0.5% this year, including for the United States. The chances of a recession in the United States are now at 35%. So purchasing of all goods, discretionary or not, are going to decrease.
Right.
And so something like Ozempic, which you need, but perhaps not as much as a cancer treatment, are going to be hit even more.
President Trump's 25% tariffs on cars imported to the U.S. officially taking effect today. Automakers responding to the new levies. Volkswagen planning to add import fees to the sticker prices of its vehicles shipped into the U.S. Meantime, Stellantis pausing production at some plants in Canada and Mexico. And Ford, benefiting from its larger-than-average inventory, announcing discounts for customers. Joining us now to break it all down, Diana Lee, Constellation's CEO. Diana, great to speak with you. Just ran through a lot of the impact we're seeing on individual names, which I know you follow very closely in your role. Talk to me about who is best positioned amid this moment.
So I think the most interesting part about all this is just because tariffs are actually announced as of today, it's not like it's going to get affected immediately. So what I mean by this is there's a lot of cars being imported right now into the US. Those vehicles were ordered over 2-3 months ago by the distributors and the manufacturers. So even though they're coming in, it's not like those vehicles, they can go back to the original distributors and say, hey, you're going to get a tariff today on those vehicles. So how the impact is really going to happen is truly 2-3 months from now. Because as those orders are happening as of today, the tariffs will actually be a part of the pricing. There are some manufacturers like Hyundai that said that they're going to actually eat the tariffs. The most interesting part about this is even if they eat the tariffs, offers are gone for new vehicles. You can't eat the tariffs and actually have a 2.9, a 4.9, or incentives on these vehicles. So if offers all go away, the prices of every vehicle, even if they eat the tariffs, will still be higher. So there won't be any incentives. Yeah. Supply will also be a factor because people are trying to figure out where to actually distribute the vehicles to actually have lower tariffs. But what people don't understand is based on the parts of every single car. So even Tesla and Rivian, who actually make all their vehicles here in the United States, will still have tariffs on the imported parts. Tesla has imported parts coming in from China. They have gone to the U.S. Trade Administration to ask for an exclusion.
Mm-hmm. Yeah, do you anticipate any of those exclusions, any negotiations moving forward?
Yes, there's negotiations all happening in the background. And the frightening part of this during the negotiations is some of the OEMs are basically saying they won't actually supply the U.S. any vehicles. Now, what happens then? It then would mean that U.S. would actually lose jobs because you wouldn't have jobs here in the United States with all these automakers actually, whether they distribute as they distribute into the U.S., there's a lot of U.S. citizens that work for many of the auto manufacturers. So if they start laying off because of the fact that they can't distribute supply here, then it will affect jobs in the United States.
So the expectation is the average life of a car on the road will just go up?
Exactly. So all new vehicles coming in the next 2 months will start actually climbing. And then the vehicles here will also be more expensive because right now we're at an all-time high of car sales because people know the tariffs are happening. So March was an amazing month. April will continue because all used vehicles, people are going to try to get those vehicles, and new vehicles that are currently on the ground will not have the tariffs and currently have incentives.
Pulling forward that demand. Will we wake up in a moment when the car companies will just not be offering some of the names that we're used to, some of the models that we're used to?
Exactly. So what's going to end up happening is the cars that are more expensive to make because of the supply disruption, they will not make those vehicles anymore. Those models will start going away. And then the frightening part is some of the OEMs are basically saying they won't actually give any supply. Well, if that happens, we will go bankrupt here in the US for those automakers, and all those jobs will be eliminated.
Where, for consumers who are really concerned about the price hikes that are going to be happening here,
Sure.
What is your advice to them? Is there any specific model out there that is most likely to have the smallest price increase?
Yes, so amusingly, obviously, it will be Tesla. Tesla will be the winner in all this. And that's also scary to me because there's 25 traditional automakers that have all funded the US American economy. And so from there, because parts are also more expensive, the consumers would actually have to pay for servicing of the vehicles at a higher rate as well. So anything to do with auto will end up going up. Hyundai has announced that they're actually advertising vehicles on Amazon, but that's at MSRP. And so as it's at MSRP, there are no discounts. Discounts are going to disappear on vehicles right now because short on supply, no offer and incentives. It's exactly like COVID years coming back. COVID, no supply of new vehicles, right?
Right.
No incentives on cars. That's going to happen again.
I do want to ask too, on a stock market level, it's interesting, we're seeing Goodyear ripping this morning. The stock was up as much as 17% earlier, now it's up about 10%, and you can see that on your screen here with our Yahoo Finance platform and our tools there. Diana, what does that move tell you about where there is opportunity for investors right now, and then of course the end impact to consumers?
Yeah, so parts that are assembled here in this country will definitely be a winner. As supply chains are all changing right now, it may come out that there are announcements like Hyundai saying that they're going to put investments here in this country and start building plants. And so there's going to be winners and losers based on who is actually producing all parts and all auto products here in the United States. That's really what's happening. And there's a lot of background conversation right now with President Trump in terms of negotiating future rates of actually producing things here in the country to avoid the tariffs right now.
Diana, thank you so much. Come back soon. Really appreciate your insights.
Absolutely. Thank you so much.
Appreciate it. We are also seeing the VIX, the volatility index, spiking, currently above 27 and rising near the year-to-date high that we saw last month. Our next guest saying to expect continued and increased volatility to come. Here with us, we've got Liz Ann Saunders, Chief Investment Strategist over at Charles Schwab. Liz Ann, great to have you this morning. What are you thinking? Where do we go from here?
So I think what the market was pricing in with a 10% correction was maybe something around the base case. And there have been a lot of best case, base case, worst case scenarios trotted out in the last several weeks. And what we ultimately got was worse than the worst case. And I think there's many facets to it. I think the lack yet of clarity on how does one negotiate this, given the somewhat simplistic methodology around coming up with these tariffs rates, where everybody's trying to figure out, all right, so what has to happen for those to come down? And there's not much clarity on that. I think another important facet to all of this that is less discussed as we look at what likely will be many firms and economists raising their probabilities of recession, I think it's well better than an even odds at this point, is the tentacles from the equity market to the economy. We have household exposure to equities at an all-time high. It's risen for every single income bracket. And it makes me think of the 2001 era where we had an economic recession that probably wouldn't have been one were it not for the weakness in the equity market. So I think we have to put an increased amount of weight on what the market does, not just for things like will it trigger the Fed to do something, but what are the actual implications for the economy? And that's additive to the downside.
And also, we are seeing that the U.S. 10-year is falling below 4% this morning for the first time since October, just since we started asking you questions here. Lizanne, what is the bond market telling you about the health of our economy and about the amount of power that the Fed has to control this economy moving forward?
Well, in general, when bond yields are keying off the growth trajectory and prospects thereof and move down, you tend to see a positive correlation with equities. So lower bond yields, lower stock prices when the bond market is keying off growth. If the bond market were keying off inflation and we saw the move down without a commensurate hit to growth, that would be a much different story for the equity market. So I think the bond market continues to be in the driver's seat, but that yield comparison to stocks as to whether it's inverse or positively correlated is a function of why yields are doing what they're doing. And down on growth expectations deteriorating quite significantly, negative for equities.
Lizanne, when you think about a higher probability of a recession, what's your expectation for the equity markets? Is this, a garden variety, mild cyclical recession where you may have to go down 20, 25% like an early 1990s, or do you think it's something that could be more ominous than that?
Well, there doesn't appear to be any significant dislocations within the financial system. So that could be something that prevents this thing from getting much worse. But if we were to see a significant tightening in financial conditions, a blowout in credit spreads, then you would call into question then the health and stability of the financial system. There's one pretty consistent determinant of whether a correction turns into a bear market or not, and that is recessions. Corrections that have not been accompanied by a recession at some point in the not too distant future tend to just stay in correction territory. Those that morph into bear markets, it's a function of recession or not. So as you see recession probabilities go up, you're probably going to see bear market probabilities go up.
And we're also seeing that traders are now fully pricing in a Fed rate cut in June. Previously, that was July. I wonder, Lizanne, how you are thinking about how these tariffs frame the market's reaction to economic data moving forward. Are we going to be back to bad economic news being good news because it gives the Fed an excuse to cut earlier?
I doubt it. I think, and at some point you get to that component or that piece in the cycle where easier monetary policy is sufficient to kind of right the economic ship. But I think it's premature to say that any kind of bad news, particularly on the labor market front, simply because it allows the Fed to ease. I'm not sure. A 25 basis point cut in the Fed funds rate sort of cures the ills of what we're likely to see in terms of tariff-related impact. Not to mention the Fed is still in a bit of a pickle because in an environment where the economy really deteriorates, given tariffs, you're probably not going to see that commensurate deterioration on the inflation front, which means they have to make decisions in the context of both sides of their mandate not sending the same message.
How do you think this ultimately settles? If the Federal Reserve can't do it with a 25 basis point cut, will we have to see greater clarity on the trade side, on the fiscal side? I mean, what are you looking for to get a sense that we may be at extreme volatility or markets may be bottoming out?
I think it has to be more clarity or just an improvement to the trade backdrop. Again, I think just a simple shift in the monetary policy reaction function to being biased back in easing mode doesn't seem like that is going to cut it. I think we also have to get through first quarter earnings season and reporting season because I think it's a fairly easy guess that what companies are going to discuss on their conference calls is any profit margin pressure they see. And what is still a consensus expectation for double-digit earnings growth in 2025, albeit down from where we were at the beginning of the year, is still predicated on very healthy profit margins and not much compression. And I think that is a clear sort of forward-looking trajectory that's now being called into question. So I think we would need to see some stabilization there. And I think we're just at the beginning of the process of any kind of re-rating that's going to happen on the profit margin side.
To what extent does the Fed have the tools to combat any weakness? Like you mentioned, obviously, the wealth effect of the equity market sell-off continuing here, but also any macroeconomic weakness. Does the Fed need fiscal policy to come in a little bit more in line in order to be able to help this economy?
I guess it depends on how you define fiscal policy. One of the frustrations in my mind to a lot of the shorthanding that's done with regard to headlines is that this will all be offset by upcoming tax cuts. We have to remember that what's being discussed here, for the most part, is the extension of 2017's tax cuts, not a whole bunch of new tax cuts, other than on the margin on overtime and Social Security and tips. But that's very different from the backdrop in 2017 when the administration offered the candy first, and that candy was massive tax cuts, which gave a boost to the economy, got the spinach later via tariffs, which were much narrower, much smaller in scope, and didn't have that retaliatory element to it. Now we're clearly getting the spinach this time, and it's much more significant than what we saw. It's not really candy, other than thinking that if those tax cuts are not extended, that would be a massive hit to the economy.
Lizanne, before we let you go, this is one of those moments in markets where it's kind of breaking through the fourth wall, and we're getting messages from friends and family who never watch the market and are freaking out about their 401ks this morning. Just want to get a chance to hear from you. What is your message to those folks who are starting to panic about the health of their retirement accounts moving forward?
Well, panic is not an investing strategy, and we always like to remind people of that. So if the goal is to try to, fully get out and then get back in at some future moment in time, get in and get out are gambling on two moments in time. That's not an investing strategy. So all along, investors should have been mindful of diversification across asset classes. The fact that international has trounced U.S. That was not a big story because everybody just assumed, or a lot of investors assumed, the U.S. is the only game in town. The concentration risk that became really, really prevalent given the dramatic outperformance of the Magnificent Seven, that has completely been turned on its head. So that rebalancing discipline would have aided investors in this kind of backdrop. And unfortunately, you sometimes learn the hard way that those tried and true disciplines around diversification across asset classes, periodic rebalancing, which just forces us to trim where there's been outsized gains. We sometimes learn the hard way that there's a big gap between what we think of as our financial risk tolerance, kind of what's on paper, and then our emotional risk tolerance.
Lizanne, really great response there. Thank you so much, and thanks for breaking all that down for us. Really appreciate it.
My pleasure. Thank you for having me.
It's time now for today's strategy session. U.S. stocks plunging at the open today amid President Trump's sweeping tariff announcements. The S&P 500 dropping by the most since January of 2022 this morning. So what is next for the market? Joining us now, we've got Peter Chur, Academy Securities Head of Macro Strategy. Peter, great to have you on set with us on a big morning here. I want to pull up a chart looking at the S&P 500 for the first 100 days of Donald Trump in office. You can see that green chart at the bottom there indicating Trump's second term in office, underperforming both Biden, first era Trump, and Obama's second term as well. What does it take for the market to recover from where we're at right now?
I think we need a change in policy. I think we've been, there's a lot of talk about how other countries don't understand the cards they have. I think the U.S. has overestimated the cards. I look at this and I look at the tariff. We are picking a fight with $80 trillion. Yes, the U.S. is the biggest economy, call it $30 trillion, but we've chosen to fight with $80 trillion. That's generally not a good way to win. And I think the expectation is within the White House, we're going to get all these calls from all these countries now desperate to fix. I think that's not how it is. I think countries have learned to play Trump very differently than Trump 1.0. If you look at Xi was the first one to come to Mar-a-Lago last time, right? And every time they mentioned tariffs, Xi and there was a Chinese delegation. This time, yeah, sure, 10% we'll take it. Sure, another 10%, we will take it. There's been no comeback. And I think what you're going to see is the world sit back, watch Trump stew. I think we're going to see inflation pressures from these tariffs. I think they're going to have to cut some or give more emergency deals like they did on potash and things like that to farmers. As we struggle, instead of coming to the table, Europe's going to come and say, hey, we're going to put 20% on your services. And I think we've misplayed our hand horribly this time. And I think unless there's a real change in working together with the world, I think this pressure keeps coming on the markets, unfortunately.
So what do you do? I was struck by Bank of America's Savita Subramanian, the title of her note this morning, "There is no tariff playbook." That as an investor, it's really hard to figure out what to do here. So what do you do?
So right now, today, I'm going to be adding a little bit to Chinese stocks. So whether it's FXI, KWEB, maybe A-share as the 3 ETFs, I think China winds up, unfortunately, being a beneficiary of this. It's not what I would have wanted, what I expected, but when you look at this, who has excess capacity? China. Who needs all these raw resources that other countries are getting tariffed on? China. So I think they become a beneficiary of this. I think it's a strategic mistake that this happens. And then domestically, I think I might try and buy one or two of the chip stocks that are building foundries here. It's the only kind of bright spot I see is we're going to need foundries here. Some companies have a head start on this. I know, there's been talk about big buildups in foreign investments. That's going to take years. So I'm looking for the companies that have already started foundries here, and I think I'm going to buy some of those. Nibble, I own them. I sold them off a little bit ahead of this. That's probably the one bright spot I see.
And I wonder how that informs how you're thinking about tech right now. We had Treasury Secretary Scott Bessent telling Bloomberg that the sell-off is related to what happened with DeepSeek and not anything related to tariffs. How are you thinking about tech right now?
I think it's kind of this combination of storms. One, did we already build out too many AI data centers? It reminds me a little bit of fiber, where in the early 2000s, we built out a lot of fiber. Eventually, it all did well, but a bunch of companies went bankrupt, so we'd overbuilt. I see a bit of that going on. I see China making some progress. And again, I see these tariffs. China doesn't have tariffs with Taiwan. China doesn't have tariffs with this. So yes, there's some trade embargoes and things like that. I think we are just feeding this and handing too much to China at a very delicate time. So I think, yes, DeepSeek has part of it, but it's only part of the story. And again, this isolationist. I keep coming back, and this is unfortunate to me, but I think we are destroying the American brand. And I'm not sure we can go back to fixing it if we continue much further down this path.
Peter, I always like talking to you because of where you work, which is Academy Securities, which manages money and has on its staff a lot of veterans, people who have military backgrounds. And I'm curious what you're hearing from them about this current moment, not just the trade strategy, but some of the military implications as well.
Yeah, so it's been really interesting. Yes, about half the firm is veterans, and we have about 30 retired generals, admirals, including a couple from the UK, as well as 2 former CIA officers. You can never quite tell with the CIA people. But yeah, I think there's some concern about the messaging. How are we doing this? And I think at some level, and I think this applies to me on the economic side, everything we're seeing geopolitically, the what doesn't bother people necessarily. Some of the points that are trying to be made are valid. It's how we go about it that's causing problems. And the one thing to me that I can't get out of my head is if you told me 3 months ago Germany was going to invest heavily in military, the U.S. defense manufacturing stock should have skyrocketed. Right. We have done something that Europe does not trust buying U.S. military equipment the way they once did. I'm sure they'll still buy some of it because of need. But that's those things that are broken. And again, to me, it's like you have this relationship, and every once in a while someone says something that you can't really pull back. I feel that that's where the U.S. has gone on this, and people don't trust us as deal makers. And I think I'm very concerned that we are doing this deglobalization, and it's going to continue. And this is probably more cynical than I am, but I keep pulling up the chart of the Nikkei, and you look at the Nikkei back in 1989, top of the world, right? Japan, everything's going to be great. Yeah. It fell 50 some odd % there and took 30 some odd years to recover. Did anyone in Japan think, oh, we're about to lose our exceptionalism? That to me is the concern here, that we are overplaying our hand, we're alienating people, we're having too many fights, and I think this can continue. So my change has to be something coming out of DC. I would like to see Bessent more in control. I think Bessent's probably the person who you listen to and people in Wall Street really trust, and he feels like he's been marginalized a little bit. So I think if he steps
and he
up,
maybe hasn't done himself any favors when he has spoken.
Yeah, so I think we need some sort of change and some realization that, first, America was pretty darn good before, right? I know on Make America Great, but America was pretty darn good. We are talking about American exceptionalism. And I think the mistake we've made is we've so focused on trade data, we missed that we had capital inflows, which were great. Yeah. People loved our brands globally. They brought our brands globally. There was a lot of good going on, and we had to fix some of those things. And this would all work better if we had spare capacity. There is no spare capacity, or minimal spare capacity, so we're not going to get the bump of manufacturing anytime soon. That's where I just feel it's been such a hodgepodge. We need organization, and the how we're doing things is destroying the what.
Peter, thank you so much. Really appreciate it.
Thanks. Sorry, I wish I could be more positive today.
No, it's all right. It's that kind of day.